Welcome back, ladies and gentlemen, for our afternoon session. We will be discussing on records to be maintained and finalization of accounts from GST perspective. We have with us Venugopal ji to present on the topic. I now request Gajendra Barulan to kindly come forward and escort our speaker onto the desk. I also request Mr. Gajendra to welcome our speaker by presenting the table. To briefly introduce about C. Venugopal ji, his partner in Mrs. Venu and Vinay, Chartered Accountant, qualified in the year 2002 by securing All India 45th rank. He is also certified information security auditor. He has also completed various other certificate courses from ICN, namely DISA, course on business valuation, course on internal audit, course in fraud detection and forensic auditing. He has also completed a one-year course from IM on data analytics and business intelligence. He is an active speaker at ICA on GST, on technology and its implementation challenges. He has authored various industry-specific handbooks on GST, conducted workshop on filing returns with ease. He has developed a lot of Excel-based free utilities on GST like JSON Reader, creating JSON files, GST and validator, composition versus regular benefit analysis, GST impact reader, etc. Apart from audits, he is a hands-on coding in BB, NET. He is also on review database designing. He has conducted various workshops for corporates on use of technology, improving efficiency, but using the Excel and all that. He was behind the development and managing of cloud applications like TaxSmile, Insta Financials and others. He is also committee member of the Institute of Chartered Accountants of India Indirect Taxes Committee. With this brief introduction, I welcome you
for your kind introduction. Very good afternoon to everybody. Hope the sessions are going great.
Yes.
And some of your concepts are getting re-altered. Your views about the provisions which you already knew is now rediscovered by the speakers. Yeah? And I heard in the input tax credit you had a great deliberations on some of the key provisions. Alright. I am clear that I am not going to alter any of your views of your GST knowledge which you have acquired. I am not going to touch upon any of the provisions which you think that you knew them, and I am not going to give a new dimension of it. However, the topic which I have is a very light. If you read your BGM, maybe it would cover some 7-8 pages. So I chose to talk about the practical side of how the books of accounts which are maintained under GST, how well we are compliant on it, and what are the things which you have to do. So maybe most of the discussions which you are going to have, you might be of experience that okay, I already knew this, but nevertheless some points which would be very critical, that if you comply with that, that will ease future assessments or any other statutory requirements. Alright. So I am going to discuss briefly on the accounts and records that needs to be maintained. So we need to be aware of what we have to comply with the law, and a little bit on the finalization of the accounts, how we present the various information of the GST related aspects in the financial statements and the CARO. Lastly, we would move on the various types of reconciliation one needs to maintain under GST. Yeah. So that's what we are going to discuss. Firstly, with the accounts and records, two pretty simple sections, section 35 and 36, which talks about maintenance of books of accounts or the relevant records one has to maintain under the law. So section 35 talks about the various records which needs to be maintained. Firstly, it is applicable only to the registered person. the question would come is, I have not registered under the Act, but I am supposed to register under the Act. Would this section be applicable to me?
Yes.
I am supposed to be registered, but I didn't register. I have violated my registration provision. So the basic principles of registration, I have violated it. Still, would I be liable to maintain the records? No. Okay. Not sure how many of you have keenly heard a couple of case laws which Jatin sir has mentioned on the first day. Tomorrow when I go back, I have not registered and I am now not complying with the section provisions what records I have to maintain. During the assessment, the officer can choose to say assessment. Now when the matter is in front of the court, can I take a plea that okay, books of accounts are not maintained, not required to be maintained, whatever I say would be the turnover, or I wouldn't even be levied for the penalty provisions. So a point one needs to read, and most of us actually keep reading the sections up to 52. Couple of sections one needs also put light on is from section 122 to 138, which are very key provisions, because now we have settled with the law, understood the basic provisions of the law. We should know what if I don't comply with the provisions of the law. So these sections actually govern when you don't comply with the law, what are the penalties, right? Now this record maintenance is applicable even if you are liable to register and you have not registered. Tomorrow at a point in time you are making a registration, even for you, those SSCs who have not registered, who are liable to register, would also have to maintain books of accounts. What books of accounts one needs to maintain? In case of a manufacturing or a production activity, all production and manufacturing of the goods, a trader or anyone who is dealing in the goods, all the stock records of the goods, with respect to inward supplies, outward supplies, input tax credit, availed, output tax payable and paid, and some certain other particulars which are mentioned in Rule 56. We'll see in a while. If you notice the Act, the section 35 requirement is only pretty simple. Are we complying with all the provisions of this in maintaining books of accounts? Most of us we feel that yes, okay, we are complying with the books of accounts. Now what does the books of accounts, what we are maintaining? The books of accounts for us is say Tally or an ERP, whatever the accounting system which is maintained. So the records which we maintain inbuilt into it. So whenever an invoice is raised today, there is nothing manual. Everything invoice is raised in the system, receipt is also accounted in the system, everything is electronic. Now everything maintained in that ERP application, would that suffice that what is required in the law has been maintained? No. Okay, some of you are saying yes. So we will see section by section where we are erring in maintaining some amount of the data. Where do we have to maintain? We have to maintain the books of accounts in principal place of business. Whatever you have registered as a principal place of business in your registration certificate, that place needs to have the books of accounts. And if you have multiple places of the business, at each and every registered place of the business, you shall have books of accounts maintained relevant to that particular place. For example, you have a godown at a place X. The godown shall contain the information relating to the stocks coming in, going out of the godown. If there is an invoice which is being raised from that place, all the taxable outward supplies, the relevant documents of that godown. So even at each location, the books of accounts of that particular place has to be made available. Maybe physical, maybe electronic. Now, can I have a centralized books of accounts? The answer is yes. Not necessary that every godown you will be maintaining the books of accounts by an accountant sitting there, but the centralized books of accounts which is maintained when an officer is visiting to the dealers, the assessor's premises, the taxpayer's premises, at that premises there shall be a record of the transactions happening in that premises. You cannot take an excuse asking him saying that you should visit the head office which maintains the books of accounts, right? It can be manual or electronic. Non-maintenance is apparent provision. Now under GST we know 10,000 is the basic fine amount. So any non-compliance with the provision of the law, the penalty begins with rupees 10,000. Couple of key persons I would like to discuss where the accounts are not maintained in an order. First comes an agent. Whenever someone is acting as an agent, today the agent can be an agent of multiple principals, and it may so happen that agent himself is present in multiple places, or agent offers his own premises as the address of the principal. In fact, the principal-agent relationship is a very thin line now you can define. Today the agents act like, again, an extended reseller where they buy the goods and sell the goods, and they take an extended credit period. So there are various situations or various kinds of business mergers or the business transactions take place. Today businesses are creative, businessmen are very creative. But if someone is acting as an agent on behalf of a principal, then agent shall have first the authorizations received by the principal that okay, he is acting as an agent and he is only remitting taxes or collecting taxes, or he is only supplying goods or receiving goods on behalf of a principal. So that needs to be established. So the authorization needs to be available in place. Next, he shall also maintain a separate set of records for each principal. So he is acting as an agent for each principal. For each principal he shall maintain separate books of accounts stating that so much goods received on account of each principal. So that kind of segregation which is generally not done, and the only simple reason, the agents are located in Tier 3 or remote villages where the principal doesn't choose to set up an office. So he operates from an agent's premises. So the agents do not sufficiently maintain books of accounts, and actually they feel that their turnover is less than 20 lakhs. They need not even register. Even a principal agent, it is mandatory, one needs to register. One important important judgment one needs to also be aware is whenever you have an extended premises, not just a principal and agent, but a godown. Now, if that location is not added as your additional place of business in your registration certificate, then that godown is not belong to you. Theoretically, you may be the owner, but from the eyes of the law, it is a separate entity. Any stock lying in that godown shall also be deemed as a supply, because you have moved your goods from your premises to a third party premises, and an officer when inspects the godown and that is not added as your place of business, you will be responsible for discharging tax on whatever the value of the goods which is lying there, because it is a supply made to another person, right? So that is one needs to be careful. When it comes to the manufacturer needs to have all the production records, but one needs to take attention that this production records would also include scrap. So the quantum of the scrap that is getting generated during the production process needs to be recorded separately. So that is one aspect which again generally gets missed out in recording the stock records or inventory records. When it comes to the service provider should also maintain the stock of the goods which are used in outward supply of those services. And the classic example is our services. All our outward services are services in nature, so nothing, we don't trade in goods. Even a service provider should have a track of the quantum of goods used or manufacturer, the way they are maintaining the stock records. Even the service provider has an obligation to maintain the stock records which are used in providing that outward supply. Now, it doesn't mean that we keep stock of number of sheets, number of pens and pencils which we are using, but however, which is more like a consumable, but when you take a large turnkey projects, eventual outcome is a works contracts is supply. Though they are a service provider, you cannot exclude yourself stating the stock records wouldn't be applicable because I am a service provider. Even a service provider, if they are using the stock of materials in providing that outward supplies, the stock records needs to be maintained. Again, this is one area where the record keeping is not complete. In case of a works contractor, it is not just sufficient that they have inward and outward supply, but such inward and outward supply should be able to be explainable to which service provider or who is the eventual customer for which you are working. So you should be able to segregate if the goods are moving out, maybe at a customer side. So the movement of the goods shall be to a person to whom the works have been executed. Take the case of when a road is being laid. Now, the goods, or the most of the time the cement or the jelly, everything is actually parked at the roadside itself. Now that is not a godown, but when the stock of records are being maintained, they shall ensure that the stock which is going out of their premises, to which is the contractor to whom that goods are moving out, because the invoicing where a works contractor does is at a time T, based on a time period, or the contract has a different activities. The invoice would happen at a time T, but the materials are moving during the course of the completion of execution of the project. So every moment shall actually record to who is the person who is to whom the goods are being taken out.
There is one question.
Yeah.
In case of works contract, there will be 100 of different kind of materials we will be using.
Right.
Do we need to keep track on the record of each and every item which is being used?
Yeah. So the question we have is that there is a works contractor. The works contractor deals with materials in large quantity. So let's take the same example of someone who is into construction industry or anything. So who does steel, cement, jelly, all these items which are being procured. Should that works contractor also maintain the records of all these items is the question. The answer is yes. Because if these items are being used in providing the outward supply, the works contractor shall maintain the stock or records of the quantity used in making that outward supply. Next comes the transporter. The transporter, though he is merely a person who is facilitating the supply chain, but the transporter is also required to maintain the records. First, transporter shall have a record of all the goods stored by him in their warehouse. He is not a supplier, neither he is a recipient, but the transporter shall have a record of all the goods which are lying in his godown. Not just in his godown, if there is goods stored in transit in a multiple godowns, at each location there shall be a record. Because I have said that wherever the goods found at a different place other than place which is there in the registration certificate, it shall be actually deemed as a supply. So now transporter, to exclude himself from this provision, he himself has to maintain records that the goods pertaining to which all the suppliers or which all recipients. So the transporter shall maintain records of the goods which are stored in his godown and all the transit godown. The second error which generally happens is warehousing, where in fact after the GST coming in place, there has been lot of warehouses which got emerged on the outskirts of each of the state. They didn't want to move the materials and create the liability. The goods are actually parked into the nearby godown or warehouse at the outskirts. Now there are a lot of warehouses which are centrally, a big godown you would find, and the place is allocated to various suppliers. Now whenever there is a central warehouse where that is facilitated as a godown for multiple suppliers, the owner of the warehouse should be in a position to exactly identify which is the area which is allocated to each supplier. In case if the demarcation doesn't happen, even there are penal provisions. So the responsibility of registration is also to all these operators who operate as a transporter or a godown. So they have to register. In fact, if they are not registered, there is a separate enrollment form for them, because they are not liable to register under GST for the purpose of discharging taxes, but for the purpose of the compliance with the law, they got to enroll on the common portal. In fact, in the e-way bill provision itself, in the e-way bill portal, one can directly register on the e-way bill portal and get a transporter ID. So the registration for them is required to comply with the law to the extent of the documents, goods stored, the record keeping of the goods stored, not for the purpose of discharging tax liability. With regards to the trader, the stock details, generally what we know a stock register would be opening balance, inward, outward and the closing balance. But an item one needs to be very specific about is if there is a loss of goods, if it is stolen, theft or disposed by way of gift or free sample, that needs to be recorded. The outward supply could be on account of supply, could be delivery challan, but it could also be on account of these activities. So the quantity, wherever you are reducing the quantity, you should specifically have a demarcation. If there are goods lost, stolen, destroyed, disposed, you have to have a separate entry for it. Why? Why do we need to have that? Just one session we had. The next, the records should be equally be maintained for the scrap and wastage. In a manufacturing process, whatever is the scrap which is generated, from the point the scrap is generated till the point the scrap is sold, the scrap is lying at the premises of the supplier. So supplier need to account for the quantity of the scrap which is generated. So it itself will constitute as another stock records. So you have to maintain again inward quantum of the scrap, scrap sold and the closing balance of the scrap. Any non-compliance of these provisions, again section 122, the penal provisions would be applicable. Is it practical to do? Of course, today the technology provides every little detail that can be maintained. Of course, it can be maintained.
What kind of a document can we actually raise to reverse the ITC for these cases?
So the question is, what is the document which I have to maintain for a reversal of ITC? Now, let's take a situation where I am a trader, the goods have come, inward is there, I am been selling, the outward is there, but there has been pilferage or there has been stolen, something happened. So I am removing the stock from my stock register. The moment I am removing stock from my stock register, I have to have a record of explaining why there is a reduction in the closing stock. Now the Act do not give a specific document as to what is the document you would be maintaining for removal of it, but you need to quantify it to reverse the input tax credit thereon. So it could be any internal document which you can maintain where you are assessing yourself as to how much is the value of the credit you are reversing and what is the value of the goods which got destroyed and which you are reducing from your stock register. Question is, can I use a delivery challan? The answer is no, because the goods are not physically moving out. It could be a document where an ERP, most ERPs have a provision to record a stock loss journal. Even when you are doing a physical stock audit, the moment stock audit is done, you update the closing stock, the journal gets automatically recorded for the stock loss. So all the ERPs provide,
SJV.
yeah, whatever the SJV.
But SJV does not have the tax element.
those JDs, yeah, we have to capture the information. Since the documentation has come, what does the Act gives about documentation? These basic documents. The documents we all know: tax invoice, bill of supply, receipt voucher, refund voucher, revised tax invoice, self-tax invoice, payment voucher, debit note, credit note, delivery challan. The point which I want to maintain, couple of points here. Tax invoice has to be used only for the taxable purpose. We cannot have an exempted supply in a tax invoice. So rule 36 is only for tax invoice. But if I am making an exempted supply, I shall issue a bill of supply. The only exception is tax invoice cum bill of supply 46A, where if the supply is made to an unregistered person, right? But most of the time, if the supplier is dealing both in taxable and exempted goods, one single document is issued. This is one documentation lacuna which happens. The second, the contents of the tax invoice needs to be verified. The rule 46 has various columns in the fields, 16, 17 fields one needs to have in a tax invoice. Now, most of the time the contents are not completely filled, and especially when a software is not a generalized software where it is a customized software. Next, when it comes for a receipt voucher, the policy of a receipt voucher or the habit of raising a receipt voucher doesn't exist most organizations. Receipt voucher is whenever I receive money, I record the receipt. In fact, today the documents are also not issued. So recording of that receipt is treated as a receipt voucher, which is answer is no. Receipt voucher is when you are receiving advance for the supplies which you have to make in a future, and you have the taxation especially for your services. So the receipt voucher is a way of a document which is creating a liability. Now again, in a document lacuna, the receipt vouchers are not identified, especially end of the month when the returns are filed. The receipt vouchers needs to be consolidated to assess how much of the tax liability you have to pay. Next lacuna is on the self-tax invoice. We know that the reverse charge liability exists, various scenarios, and we calculate reverse charge liability. We discharge the taxes in 3B. Currently, since 2 is not there, or we do not need to report it. But whenever we are discharging the reverse charge liability in the 3B, there is a calculation which is there in the back end as to why I have arrived so much taxes needs to be paid. And I have also taken input tax credit. But again, while for taking an input tax credit, you need to have a valid document. The valid document for you to take an input tax credit is your self-tax invoice which one would raise for the reverse charge services, all the reverse charge application. So reverse charge, also the Act has given a provision that the reverse charge invoice can be single invoice once in a month. So for all your intrastate supplies you can have one reverse charge invoice, and for self-tax invoice and all interstate supplies. But this document is internally again not maintained by the most of the SSCs. Next, when it comes to your debit note and a credit note, I know you had a detailed discussion on an accounting credit note vis-a-vis the credit note as per the law. Now, credit note as per the law can be issued only in certain situations. But wherever, from the accounting perspective, whenever I am crediting a party, it is a credit note. The voucher I can use in an ERP is a credit note. I am crediting a party and debiting my expenditure or reducing income. It could be any of that. So, credit note for the purpose of GST can be used only in the specified purposes only. All other aspects are an accounting credit note. So, the credit notes are generally used for crediting the party. So the segregation should be an accounting credit note versus GST credit note has to be there in the ERP, which is again currently not maintained. So these are general lacuna in the documentation.
Sir, excuse me.
Yes.
What is the time limit, sir? You have mentioned it is a credit note.
Yeah, so the credit note as per the GST has a time limit, which is
From the recipients.
earlier we had that 6 months VAT loss and other loss, but under GST the credit note time limit is
September.
yes, up until September of the financial year, subsequent financial year, the credit note has to be issued, can be issued. So again, that is one other thing, an area one can check if there are some credit notes which needs to be raised. For example, you made a supply up until March, but you have not received the payment. Then during the discussion, discussion with the receivable team or anyone, they may come back and say that the goods haven't even received that party, or the party has rejected the goods. The goods are coming back and lying in our godown. There could be various reasons. The time limit for you to raise the credit note is September. So the September up to 30th September the time limit would be. So within which one has to raise the credit note. So the credit note raised up to September, you have an opportunity of reducing whatever the tax liability you have already discharged, and you can adjust in the subsequent tax liability.
There is a price reduction.
If I receive that credit note on, say, based on September, but he didn't issue the physical copy, or I didn't receive the physical copy, am I under obligation to reverse it in November or December when I actually get the note?
Okay, so that's what I am going to discuss in this slide on the documents thing. So the question is, credit note I have issued in time before September, but recipient did not get it, and today how are these invoices are sent? That sent in email, very less of the physical copy. Email is not read. Now I read the email only in December. The supplier has issued credit note, reduced his tax liability. Recipient is considering it in the month of December. Is it valid?
No. As per the requirement, the liability gets reduced only if the buyer has reversed his credit.
Yeah. So sir is saying it is a clear no as per the requirement, the liability gets reduced only when the recipient reduces his input tax credit, which is very theoretical. Now today let's look at how the law is operating. Am I taking input tax credit whenever I get the materials? The month in which I am getting the materials, am I not taking input tax credit? Yes or no? Am I actually looking at, did the supplier file the return? Did he pay the taxes? But as per the law, you should also check whether the supplier has discharged the liability under section 39, filed the returns, all that complaints. So the main purpose of the GST was a matching concept. The credit is a liability of a third person, or liability reduction is a credit reduction of a third person. So to answer your question, I am reversing in the December, is it valid in the law? The answer is no. Practically, is that what we are doing? Answer is yes.
Sir, excuse me.
Yes, sir.
On tax invoice, so some of the dealers who are dealing on both exempted and taxable, does the invoice on the same invoice? So for example, textbook and notebook, while supplying to the school students.
Yeah.
So what is the risk in that?
Yeah, so a dealer, an SSC taxpayer is issuing a single invoice, supply of textbooks, say taxable items, exempted items, and supply of notebooks, which is a taxable item, both put together issued in one invoice. Permitted?
46A only for basic.
Yeah. So as I said, if it is to the school students, but they are end customer, the recipients, it is practically not possible to every time segregate. Imagine the case of Big Bazaar. You go to the Big Bazaar, and especially on the off days, Tuesday, Wednesday, where they give discounts. There is a huge queue. Then the cashier says, okay, please segregate your taxable items at one place, exempted at one place, I will issue 2 bills. Very practically not possible. So if the supply is to an end customer, then it is permitted. But if the supply is to a registered person, then it is not permitted as per the law. So what are the things which you are not really complying? Self-claimed tax invoice is not done in time. The necessary fields which have to have the tax invoice is not there whenever it is an invoice generated by Excel or a customized software. Receipt voucher, payment voucher, credit note, debit note, accounting debit note, accounting receipt voucher is merged with regular receipt voucher, regular payment voucher. All this happens. Invoice numbers have to be serially maintained, and if I am maintaining a separate series, that also permitted, I have to report. Firstly, invoice numbers are reserved. So month end, the marketing manager says, okay, please block 2 invoices, I have a customer order. Those numbers are blocked. The blocked numbers which never gets utilized, nor there is a trace of what is happening to those series of invoice which is not really utilized. I am maintaining separate series for each district, each zone or each category of the products, but reporting of that is not really happening. Then invoices, as we said, most of the times it is generated over Excel or ERP. They have an ability to convert to PDF. It gets converted to PDF, and today I will attach and scan the image and it is emailed. Theoretically, it is actually not valid as per the law. The invoice shall be digitally signed by the authorized representative or physical signature. So an electronic invoice which is not digitally signed is not a valid tax invoice. Again, this is the lacuna which is happening in the record keeping. Moving on, where the books of accounts are maintained manually. Are there books of accounts maintained manually? Yes, sir.
I have a question.
Yes, sir.
I am a buyer from an MSME vendor.
You are a buyer for?
MSME vendor.
Yeah.
So under the MSME Act, I am supposed to pay it within 45 days. Suppose I don't pay within 45 days. Suppose there is a payment I made it on 60th day. So there is a delay of 15 days, for which he is supposed to charge me interest at the rate of 80%. So on that, GST is liable. So what document I should collect from him under this? What is the document I have to collect from him?
Okay. So the question is, I have made a purchase from a vendor who is an MSME. Now, under the MSME Act, I have to pay him within a stipulated time. Otherwise, also most of our invoices, we have the standard terms and conditions. If not paid within so and so days, 18% the interest for the delay. 99% of that times, no one has regard to that provision. But for some reason, I am a very compliant recipient. I am paying with the delay, so I am also paying with interest. I am paying with the delay and I am paying with interest. Now the question is, the interest which I am paying to him on a delayed payment, would it be part of section 15? The value of supply?
Yes.
By the supplier? So it should be part of the outward supply? Now, the question is, should there be a GST on it? The answer is yes. What document the supplier has to issue? Is there an invoice? Absolutely no. The supplier has to issue a debit note because there is an increase in the value.
For debit note, there are only 4 cases where we can issue.
That is for credit. The cases for, okay, the 4 cases which to be complied is for credit note.
Not for debit.
And the time limit is only for credit note. Debit note, there is no time limit. 10 years later also you can issue debit note. Because in debit note what is happening? You are collecting taxes and paying it to the government. So government will not stop you. Whenever you want, you can do it. Alright?
In case the goods are returned beyond the time limit, so it should be under the cover of an invoice.
If the goods are returned beyond the time limit,
Where I cannot issue a credit note.
and I cannot issue a credit note, okay, what is the question?
So it has to be returned under the cover of an invoice.
It has to be returned under the cover of an invoice. Act doesn't say that.
So what
Fresh invoice, yes.
Question is, can it be issued under cover of invoice? Answer is yes. So as a purchaser, recipient, when I am rejecting my goods, I am sending the goods. The goods which are getting returned, I can treat it as a supply, raise an invoice to the supplier, permitted. But I choose not to raise an invoice and the supplier has to issue a credit note. The time limit is again N, but issued up to September, the liability can be reduced. Credit notes issued after September, the supplier cannot reduce his liability. But as a recipient, I have rejected those goods, my input tax credit will still be rejected or reduced even after 10 years. Clear? Now, if books are maintained manually, the question is, today in this electronic world, does someone maintain books manually? Is it practical? Okay, there are a lot of people who maintain books manually. In fact, 99% of the people maintain books manually. What? 99%? When I say books maintained manually, doesn't literally mean all the financial books. If you notice, even large corporates maintain the stock records manually. They have the storekeeper who is a diligent custodian. He maintains whenever the goods coming in, going out, they maintain it. So when I am saying books are maintaining manually, doesn't mean that only the financial books. The books which are required for the GST, which shows the movement of the stock, the movement of inward outward supply, or the tax payable, input tax credit. In fact, GST expects only that books of accounts. So the question is, if someone is maintaining those books of accounts manually, they have to maintain such a way that they shall not be erased. Meaning, please do not write with pencil, write only with pen. And whenever you are making changes to it, other than clerical in nature, like instead of writing 28,500 as the next page opening balance, I have written 25,800, which is a clerical in nature, which is apparently you have to correct it. Other than those, if you are changing any of the values in those records, every time there is a correction, that correction has to be authenticated. Now this is something, again, no one follows. Then when the books are maintained electronically, there shall be a log. Now we may say that, okay, I am not an IT person, I don't know what a log means. But if when the books are maintained electronically, there shall be a log of what all the transactions which are happening. Let's take, I am not biased to any software. Let's take a desktop application and a cloud application. Now, whenever a transactions which happen on a cloud application, eventually there would be a track. But let's take a desktop application, like an Excel based thing, and like the popularly used software Tally. If the controls are not maintained in the Tally, the same example which we have seen, that the stock records are written by pencil. Because I post an entry, I delete an entry, I feel that the entry is not correct, I enter it and I change it. So it's as good as the records maintained by pencil, because they are maintained in such a way that it can be erased. So one has to enable a log of transaction. Even if a transaction is deleted, it is stored and recorded why it is deleted. Again, 99% of the time we don't do this. So my job is only to tell you what we are not doing it. Next, authentication. Those records which are maintained electronically, and submitted to the officer in an electronic form, the authentication of these electronic documents has to be done by a digital signature. Physical records and physical signature, but electronic records by a digital signature. Now, can I keep the centralized books at one place? The answer we have already discussed in the first slide. Answer is a yes and no. You maintain books of accounts centrally, but you have to make it available at each place of business.
The accounts and records being digitally sent. What does voucher understand?
Those records which when you are furnishing to the officer, or you are giving it for the audit, where the documents are submitted as electronic, the accounts and records have to be digitally signed.
Records is fine. Accounts. When you say probably
Which is the backup version where you give. See, today the officers ask you when a notice is sent, if the books of accounts are maintained in the Tally, send me the Tally backup. They say I will open the data here and see it myself. Or if it is a cloud application, share the username, create an audit account and give us an access. So today the officers also have become tech savvy. So whenever documents are shared electronically, the right procedure is those documents have to be digitally signed and shared.
that backup can be digitally
Yeah, every document, every electronic document can be signed digitally. There are multiple ways of doing it. It can be done.
Sir, restricted access is allowed?
Restricted, okay. Is restricted access allowed to an officer? Is that the question?
Yeah.
Okay. That's the question. Can I give a restricted access to the officer? So first question is, what is the restricted access?
Allow only specific places.
So the question is, only view access or view of only one set of books of accounts?
It's a limited access.
Limited access, no, limited access of, so limited view. So let the officer do not see my customer's name. Let the officer does not see my shareholders list. Is that, or let him not see profit. So you cannot actually have a restricted access. So if you see the audit provisions and the access to business premises section 71, which clearly says that not just the books of accounts you are maintaining under the GST. If any other law you are maintaining, any books of accounts which are required to maintain, all the access to those records are also available to the officer. So you cannot have a restrictive access to the officers. The next is the onus of maintaining backup is on the registered taxpayer person. You cannot say that, okay, I lost the data and the popularly used, the ransomware got hit. You cannot take that excuse. Whenever the officer is asking to produce a hard copy on demand, you have to produce hard copy on demand. If the document is such a way that it cannot be collatable or unexplainable, like when someone goes to concurrent audit, he gives you a big PDF file or a big text file, which you will open it for 5 minutes. After that, you will see page 1, page 2 lying various data and beyond your understanding. So most of the officers also have a lot of data beyond understanding. So at those times they can also demand for the hard copy of the data. And if you are giving that restricted access by protecting password, please share the password to the officers.
What is the reasonable period of time for backup?
What is the reasonable period of time for the backup? There is no reasonable time. Whenever the officer is asking for the information, you have to provide. Backup should be available. You need to have a backup. Yeah, so that the data loss can be recovered. So you should have it's like you say, today my data is lost. So the next moment you should have backup to give the previous day's data, whatever is the last recoverable version. The other points, I said the advances not maintained. Next important point, if a documents or records found at a premises of another person, it would also be construed as a documents of yours unless otherwise you prove it that okay, those documents do not pertain to you. And especially when the bookkeeping is outsourced, so you need to have a documents back to your places wherever the documents are outsourced. How long we have to keep? Very simple, 72 months, 6 years. From when? End of the financial year? End of the due date of filing the annual return, which is 31st December. But if there is any appeal or any provisions which are going on, then you should have additional 1 year from the date of the order of proceedings. Let's look at other non-compliance. Registration certificate should be displayed in the premises. Again, generally not complied. Registering to be printed in the name board, generally not complied. HSN details to be issued in the invoice as per the whatever the turnover criteria, generally not complied. Authorized signatory, whenever it is changed, that has to be updated. Again, that is not complied. Like director resigns or CFO resigns, but the digital signature is there. As long as the digital signature expires, the 2 years validity is there, the same signature, use it for filing the returns also. Some other non-compliance, not complete set of books of accounts maintained. Like we saw, what are the ingredients of various places where the books are not maintained. Stock records not maintained. Since I am in supply of services, wherever the stock used in terms of the supply of goods, where in the purpose of providing outward supply of services, the stock records to be maintained, that is not maintained. In the stock records, the HSN details are not maintained. The month-end closing entries are not posted. Advances received is not tracked with regards to the output tax liabilities paid. The government portal records which the government is maintaining, the electronic record which is cash ledger, credit ledger and the liability ledger, is not maintained or reconciled with the books of accounts. While I come to the reconciliation, I will explain this part in detail, but again this is one general non-compliance with the books of accounts.
With respect to that advances,
Yeah.
advances received and advances adjustment entry. Once I receive an advance, I have to pass a receipt voucher.
Correct.
GST receipt voucher, which is not as simple as just a double entry which you pass. It should capture even the tax details.
Right.
So meaning like, for every, at the entry level, we should have the tracking for the GST paid with respect to advance.
Like self-tax invoices, whatever is the advances received, you have to capture the HSN liability of what the outward supplies if you have multiple outward supplies. Otherwise, end of the month you are discharging the liability on the advance.
If you look at the receipt voucher format, it says taxable value, tax amount, type of tax, rate of tax, everything.
Correct.
Almost equivalent to an invoice.
Correct.
The name would be a receipt voucher. So when I incorporate that at the entry level, so there itself it would be at each entry level I have to be able to track it and then adjust the advance.
Yeah, so the question is, the receipt voucher which is defined in the rules, same like my tax invoice, debit note, credit note, it also has all the information. Should I capture all the information? The answer is yes. Whenever you are recording a receipt voucher, you have to capture what is the liability which is arising out of it. But that doesn't mean that you are actually creating another ledger or anything, which is when I am assuming I am booking this hall for a session to be done 10 days later. I am paying the advance to the ICI and 10,000 rupees. But for the books of ICI, it is an advance received 10,000 which is inclusive of taxes. Nor in my books I will say 9,000 advance paid towards the hall and 1,000 towards the taxes. It is 10,000 which is inclusive of taxes. But while which is getting recorded by the supplier's book, they have to have an underlying entry under which HSN this is getting recorded. So the ERPs has an ability to capture this underlying information because this tax is notionally calculated. It is an artificial liability which gets created to offset against the adjustment on the future supply. So it is not an accounting entry.
Ledger level I can have it monthly once.
Correct.
That's fine.
One question.
Yeah.
44 AD of income tax gives an option not to maintain records.
So the question is 44 AD of income tax gives an option of non-maintaining books of accounts. I will go that 8% or whatever the percentage I will declare turnover. Is it valid in the law? Valid in income tax act.
It's contradicting the requirement from both GST and income tax.
It is not a contradicting requirement. Under GST, you maintain GST records.
This is also substantial amount.
So for the purpose of income tax, you can say that okay, I have not maintained the income tax returns. But when it comes to the GST, you are discharging your outward supplies. Let's take my turnover is 60 lakhs. Okay, let's hypothetically take my turnover is 60 lakhs. End of the month, should I pay tax on the supplies which I made or not? Yes or no? Yes. To pay the tax, I need to calculate what is my outward supply. So in some fashion, so GST, if you read section 35, doesn't talk about mercantile basis of books of account. It doesn't talk about double entry system. It doesn't talk about bank reconciliation. It does not talk about 100 things which someone has to generally comply with the books of accounts. Clear? Next, the disintegrated books. So today we have multiple, so POS for billing, production or excise manufacturing system has a production records, financial has an ERP. So I have multiple accounting systems or multiple ERP applications within the organization. But between the applications, the data is not reconciled. You may say that this is the data for my production records or this is the application I am relying on my billing. that doesn't mean that the financial records will be disregarded. You have to have an integration or the reconciliation between multiple applications that you are using. Then the softwares which are being used, especially the generalized softwares, most of the generalized softwares are compliant with the GST laws. But to make an application compliant, those need to be specifically configured. Configurations of this software is generally not done, or some features is not done. One has to again take special look into it. And the ERPs also provide a single set of records. So I have presence all over India. I am maintaining books under single ERP. Permitted, you can maintain under single ERP. GST never stops it. But you should have an ability to extract the data pertaining to each of the sub-justices. Then let's look at disclosure in my financial statements and carve. Firstly, in my financial statements, my input tax credit.
Sir,
Yes.
to keep the books of accounts, you said additional place of business. Suppose if there is a space constraint.
Okay. The place of business is my books of accounts, and I am into like Big Bazaar, where I have bundles of vouchers which come out. I will find a different godown and hire and stock all my vouchers there. Is it permitted? Permitted. Add that as your additional place of business.
The house can be considered additional place?
My house can be considered as additional place for my business?
No,
Okay.
only for record keeping, not for conducting the business.
Sir, record keeping itself is additional place of business. A corporate office which does only bookkeeping for the operations across India is also a place of business, because access to the business premises is all those places which is listed. If you do not add it as additional place of business, but if documents are found at a later point, the officer can construe or deem it as a place of business. So that is what we have seen. If documents are found at an else place also. First, the reporting, the input tax credit and output tax liability. Should I net it off? Should I show it gross? Should I net it off? Should I show it gross? Like income tax, provision for taxes and the TDS. Should it be netted off? Should it be shown gross?
Nated for each state.
Netted for each state. Okay. Whenever you are filing your monthly return, which is prominently now 3B, you are offsetting your liability. So which you are relinquishing your right as an asset, you are also discharging your liability. So the credit loses the moment you offset your liability. So your input tax credit, for the purpose of disclosure to the financial statement, to the extent you have done your offset of your liability, you have to net it off and the net credit only to be recorded. But wherever you have not adjusted, it will be shown at a gross level itself. The point number one. The point number two, when I am saying that it is netted off at a 3B level, is I have multiple states, and in one state I have an excess credit which is still not offset. But another state, or on 31st March, I have a liability, so I cannot merge all those liabilities and assets, because that credit is technically not allowable as an adjustment as a liability of another state. So the netting off also has to be done, where you can offset in a 3B, only those credits and liabilities can be netted off and presented.
But as on 31st March, I wouldn't have offset it practically. So, my output will be there and even the input will be there.
As of 31st March, which I have not offset, I would have an output and an input which is separately, technically has to be shown separately, because when we record my month closing entries, which I'll explain, it will automatically take care of recording it separately. Next, whenever a GST is paid on reverse charge transactions, what would that be as? Where do I have to disclose? Again, it is an artificial asset and a liability, which is like a liability and an asset which is creating, and till you again offset or merge with your credit ledger or the records, it will be still shown at a gross level till the offset happens. Whenever the credit which you have taken is not matching with the counterparty filing, that is especially difference between your records and 2A, what do you do? How do you present that? Answer is there. See, first, you can continue retaining in your credit ledger, no harm. You can choose to debit to the supplier, because supplier has not paid it. You can reduce from your credit ledger and debit to the supplier, because you have an obligation to reverse it. You cannot continue to take that credit. And if you feel that supplier is not traceable, you have to debit it to your P&L account. Whenever you are debiting to your P&L account, it has to be debited to the natural head of account, not rates and taxes. Most of the time tax reversal happens to the rates and taxes. This is again an error. Electronic cash balance in your electronic cash ledger. Now, balance in your electronic cash ledger doesn't become cash and cash equivalents. Payment of taxes to the government itself doesn't imply that you have discharged your liability. The way the electronic cash ledger is recognized for the purpose of GST is like your extended wallet, where you park your money in a Paytm wallet or another place, which you can use it for setting off towards liability, or whenever you want you can draw back, transfer it to your bank account. Now, having said that this electronic cash ledger is like a wallet, it cannot be recognized as your cash and cash equivalents. Very simple reason, GSTN is not an RBI recognized entity to collect the cash, so it is not, they do not have a banking license, it is still your other current assets.
So you mean to say that 43B, suppose some liabilities are there and if it is balance lying under cash ledger, I cannot offset. Say,
I didn't get the question.
Say for example, 1 lakh rupees payable is there, some mistake is there, and then suppose I have 20,000 rupees lying in my cash ledger. So should I have to disallow 80,000 or 1 lakh rupees under 43B?
Okay, I am not an subject expert to talk on income tax. I have an output tax liability of 1 lakh of GST, 20,000 electronic cash ledger balance.
I am not offsetted in 3B.
You are not offset in 3B. Your books of accounts will show 1 lakh current liabilities, duties and taxes, however you want to show. This 20,000 your other current asset. Tomorrow you may withdraw that cash, you will not offset it. In the subsequent month you have a choice to offset against that liability, or you withdraw that cash and you will offset with input tax credit also. So you cannot net it off and present it for the purpose of the balance sheet. Refund.
The same question what is it like reverse to natural hedge. What happens if there is a capital goods? Should we, because they are availing and then reversing, should we claim depreciation on adding back to the capital goods or
Yeah, so very interesting question. Capital goods input tax credit very well permitted, but rule 43 wherever put to use for an exempted I am reversing some credit. Whenever that credit is reversed, can I capitalize it? Most of you might be accounting experts. What does AS 10 say? Or revised accounting standard. Can I capitalize it? Or should it be charged to P&L account only? Because I said whenever taxes are reversed, it has to be transferred to the natural head of account. The natural head of account for this is a capitalized. Should it be capitalized or can it be capitalized?
No, it's a prior period error. After installation, if it is a subsequent event, you cannot.
So you should definitely consult your accounting expert. But my reading of AS10 permits you to capitalize these costs, because it says those taxes where the credit is not taken are eligible to be capitalized. You can capitalize. Now that is year 1. What about year 2, year 3, year 4? Is it permitted? Theoretically, even it is an increase in the value, it is the original value of the asset which should have been capitalized, can be capitalized. Yes.
But 16.4 says to avail an input tax credit, you should not have claimed depreciation on that.
Yeah, I have not.
Availing and reversing.
Yeah, I am not. So the question is, am I contradicting to 16?
Yeah.
So it will get into a circular loop as a discussion. I am capitalizing it after being disallowed, which is I came out of that loop and now capitalizing it. I did not capitalize it when I have taken the credit. Okay, moving on. Refund. Whenever a refund is applied, it is automatically debited to your electronic credit ledger. To that extent, the balance is removed from your credit ledger and the refund is processed. So, the natural head of the credit was other current asset. Even the refund applied would continue to other current asset. Whenever the refund is disallowed, passed on to your credit ledger, it becomes a credit. But wherever the refund is completely disallowed and moved to your consumer welfare fund, it actually becomes your expenses. Whenever you receive a notice from the department, show cause notice, you do not have an obligation to report it to your notes account because it is just a notice. It is their contention. Their contention doesn't mean that you also agree to it. But when there is a demand order which has been raised, definitely it needs call for reporting in your notes accounts. If needs be, you have to make a provision, you would make a provision. Under excise duty, the turnover was reported on a gross basis. Should we continue reporting under gross basis even under GST? We used to show the gross turnover less excise duty paid. Is that the same thing should be followed? Because I am still doing the manufacturing activity and everything. The answer is no. You have to show a net turnover. Revenue recognition accounting policy, no need of mentioning anything relating to GST. Contingent liability, whenever your order is received, when you are making a provision or you want to show it as a notes account, you would only show it. Let's see how is it reported in CARO. CARO has two reporting points, 37A and B. One when it is undisputed, the second when it is disputed. Let's first look at when there is no dispute. First, what does the para says? It says depositing of undisputed statutory dues, blah 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 blah, and if it is outstanding for a period more than 6 months. So the reporting under CARO comes only when the outstanding undisputed not paid more than 6 months. Even if it is 1 rupee, you have to comply with it. The question is, what does this 6 months mean? As on 31st March, what does 6 months mean?
From the date of due date.
From the due date. So, due date of, so for up to which month data, if it is not paid, will get reported? September liability, would it get reported? September liability not paid as on 31st March, would it get reported in the CARO? Yeah, so if you see more than 6 months, from the date they became payable. So the date they become payable is 20th. So August liability not discharged would come into your CARO. Let's see how does it come.
Extended
from the extended due date. So firstly, the intention is to report if there is a irregularity in reporting. So as a statutory auditor, you will not go and check whether or not they have applied correct rate of tax and is the correct amount of tax shown. Apparently what is shown in the records is what you will be taking. Next, you will be commenting for the regularity and long pending. Long pending, we saw more than 6 months. Let's look at regularity. Yeah, we discussed when it becomes payable, when it is due date. So firstly, you have to take a management representation letter. Yes.
3 slides. I have a query more from a letter of the law perspective.
Which one?
Yeah, here.
Yeah.
See, the CARO requirement is to report sales tax or service tax or letter of the law in reference to GST does not come.
Yeah, that is why the last point I have included. I know you will get a questions like this. So there is a word called any other statutory dues. Your any other statutory dues would also include GST. Thank you for asking the question. Alright, so one has to take an undertaking that the compliance to the GST law has been met. because while conducting the statutory audit, you are not expected to look the provisions of the GST has been completely met by the SSE or not. So you will be taking an undertaking that they have considered all the liabilities. After taking that undertaking, you would report in your CARO the long pending, we saw the 6 months. For the regularity, you have to yourself take that subjective position. Are you satisfied completely, or are you partially satisfied, or are you partially not satisfied, or you are not satisfied? I don't know. The not satisfied is easy to make a decision, but partially satisfied, partially not satisfied is something difficult call for me to actually say it. But it is a subjective opinion of the auditor. If you are satisfied, you would say that the SSE is regular in depositing the dues to the authority. Whenever it is partially satisfied, you would use lastly, there has been slight delay in few cases. That's the word you would use. And when it is partially not satisfied, you would say they are not generally been depositing the dues. And when you are completely not satisfied, you would say they have not been regularly depositing the dues. So this is a small change in the terminology, a very minor difference. So you have to put yourself, whether you are satisfied, fully satisfied, partially not satisfied, or completely not satisfied, and accordingly you have to adopt this para and report it. In terms of the outstanding, if the dues exceed more than 6 months, you would give the nature of the statute, the nature of the due, amount, the period for which it pertains, what was the due date. If it is paid subsequently also, you would have to report it, because as on 31st March it is outstanding beyond 6 months, you would have to report it. Moving on to the not deposited because of a dispute case. It is not deposited because there is a dispute. Now, merely a representation made by the department doesn't call for that, okay, I have to agree that, okay, there is a liability. I can still dispute. But one has to take it in a cognizance that whenever a department is sending an order or sending a notice, there is a timeline within which you have to respond. If you are not responding, if you are not contending, or you are not filing an appeal against it, it is deemed that you are not disputing, then it would move to the first category of not dispute case. So you have to assess, in case if there is a dispute, you have to actually assess the status of the case, satisfy yourself whether it falls as dispute, not dispute. If there is an appeal to be filed, whether they have filed the appeal or not, you have to evaluate and pass through all those tests. Once you have cleared and passed through all those tests, then you have to make a reporting whether or not it has been provided. The reporting under this section doesn't look for a warranty if the SSE has made a provision or SSE has not made a provision. See, making a provision, it is an accounting judgment, it has got nothing to do with the GST. But for the purpose of reporting, you wouldn't take a cognizance of whether or not it has been provided. You would have to report of all disputed dues. So wherever there is a dispute, all those disputed dues, again name of the statute, nature of the due, amount, the period for which it relates to, the forum in which it is pending, whatever the remarks, if any. So even if there is a disputed dues which has been provided, you will still report. It is not provided, you would still report. Mere provision doesn't mean that you have acknowledged it as your liability. Sometimes you would want to, as a cautious, you would want to make a provision in the books. So mere provision doesn't take away the nature that it is not disputed liability. So is tea ready? Okay. So we will take one slide and we will take a tea break, which is we will move on to the reconciliations. So before reconciliation, we should be aware that government also has given an opportunity to file an annual return for correcting whatever uncorrected errors. So a regular dealer would file GSTR 9, a composition dealer would file GSTR 9A, an e-commerce operator would file 9B. All other dealers, all other SSCs need not file their annual returns, which is your ISD, CTP, NRTP, TDS, all those dealers, SSCs do not have a requirement to file the annual return. If the turnover exceeds more than 2 crores, you will have to file along with the annual return an audit report on or before 31st December of the subsequent financial year.
The reconciliation statement is with 9 or 9?
Reconciliation statement, GSTR 9 is your annual return, which is along with your reconciliation statement. 9C is your so this is 9 is your ITR, 9C is your 3CB, 3CD.
Reconciliation is must for every year.
Yeah. So annual return is more your reconciliation statement. What does that reconciliation statement contain? All my outward supplies excluding RCM, the taxes, goods sold and goods returned, goods purchased and goods returned, input tax credit availed and reversed, tax payable and tax paid, refund claimed and refund claimed. So you would be summarizing all the transactions of the full financial year. If you have to make any corrections thereon, you will make the corrections thereon and file your annual return. So what we will do is we will take a quick break and we will come back in looking at the reconciliations. One last question.
Sir, your point addressed issues when it comes to CARO. What about the organizations, companies that CARO may not apply? Do you include your views on what we should do in reporting?
Okay, so the question of reporting where I give a simple audit report, I do not give the detailed annexures, CARO and everything. How should this be reported? Or should it all be reported? In my view, wherever you have a CARO reporting, this needs to be reported. Otherwise, when the law itself doesn't expect you to report, do not get into a detailed internal audit report in your statutory audit report. So we'll come back quick. Okay, for your information, today's session is little reduced. So Madhukar sir would also be handling the session. So please request you to come back quick. Indirect taxes committee slide was coming up. I just saw. If you have not registered yourself on the indirect taxes committee website, I would personally recommend you should register yourself. You will get updates of the GST. And I know WhatsApp would get flooded whenever a notification comes or any changes comes. But the indirect taxes committee updates come on a fortnightly basis, and where we consolidate all the gist of the notifications. So we have 2 updates, one on the case laws and one of the notifications and the summary of the changes. So that is one important update and a very useful material. Second, the industry specific publications and all other some research publications are available on the IDTC website, including the BGM which you have with your hand. The soft copy is there. So those of you are very fond of reading on your laptop or iPad, that's a useful material. A lot of materials are available. Please register. You download any industry specific, and a lot of good materials are there on the IDTC website. Do we commence? Wait for someone. Alright, thank you. Okay, let's begin. So, moving on, before you file the annual return, I said annual return is an opportunity for you to correct the errors which you have missed out. In fact, circular 26 has been issued, the last circular of the previous year, 26/2017, has explained how one needs to make corrections if there is any error. In fact, during the break, 2 questions which I got is of an error happened in the return. So, circular 26 neatly explained whenever you made any error, the returns in the returns, it can be corrected in the subsequent returns. Currently, we are filing only 3B and GSTR 1. So, all that it said is, if you have the error could be either a short disclosed liability or over disclosed the liability, or it would have been cross adjustment. Similarly,
any missing invoices?
Missing invoice means your liability is under disclosed. The errors would fit into only this category. Liability is lower, liability is more, or it is the cross reported. input tax credit more taken, short taken or cross reported. Correct? Any error should fit into any of these things. So if the error is of GSTR 1, they said subsequent month add it into your GSTR 1. Assuming April to July to March, I did not disclose anything in GSTR 1. Nil return, file nil return. In the month of April, I can add all those invoices, put it in your table for all your B2B, all that put it in your table for and report it, permit it. So any correct error, missed out invoices, add it into the subsequent month. But I have reported over. So when you have excess reported, you have table 9 and table 10 for amending B2B and B2C. Use those tables to correct the reported data. Missed data, add it into the natural table. Over-reported data or wrong data, amend it. That is for GSTR 1. When it comes to GSTR 3B, go to the next month, reduce or adjust the turnover so that the difference is captured. Example, month of June, my turnover is 10,000 rupees. I have disclosed it as 2,000 rupees. I have short disclosed my 8,000 rupees. In the month of July, add that 8,000 to the subsequent month and liability and discharge it. Vice versa for liability. So instead of 10,000 rupees my turnover, 2,000 rupees my liability, I have disclosed it as 10,000 rupees. 8,000 excess disclosed in the month of June. Come to the next month, reduce your liability of 8,000 in the subsequent month. What happens if you do not have liability in the subsequent month? We know that AS22, timing difference, permanent difference, you calculate how much of it you will carry forward to the subsequent month and till you find it that you will adjust. If you feel that you have reported so much liability, never you will adjust and you have overpaid the taxes, Section 54 has permitted you to wrong payment of taxes. In the circular also they have said you claim a refund if you feel that you will not be able to adjust the liability in the subsequent periods. And when it comes to the input tax credit, you have table 4B for reversal of credits which you have taken earlier in the excess period. So circular 26 beautifully explained, one can take use of it for correcting.
So can I take the credit also? Suppose if some of the images...
I missed out taking credit in the month of March. Can I take the credit now? The answer is yes, you can take the credit. Till when I can take the credit? Valid up to September of the current financial year for the previous financial year. So September return is the last return to take all the credits, missed out credits. It is actually filing of the annual return or filing of the September return, whichever is earlier. Annual return for sure will be filing on the December. In fact, we have a good practice. We have been given a right to file on 20th. We will exercise the right. We will always file on the last day of all the due dates.
So why in the GST they have given the 60 days time for the annual return filing? Why they have given the 9 months?
In VAT also the annual return was December is the due date.
But is only in September was there, but in the initial period they extended to the December.
No, VAT regime that was...
Last year, that is the only 6 months period. So September 30th was the last time. Because of some reason they given the December. The first year itself it was 6 months.
It is December, sir.
In the first year, the VAT introduced, that is a 6 months only. September 30th to the last.
But after that they made it to December and they continued with December. GST also continued with December. And see, if we answer why December, it's like I'm not the right person to answer it.
60 days, it is a better, so they can reconcile. The input credit also taken 30.
No, that is why you have, see, the good part of December is your tax audit is also completing by September. Then if you have corrected anything in your tax audit, you can correct it and file it in your
tax audit is affected because of the 9 months.
Okay. This December is the upper end. You want to file your annual return on 1st April, you have right to file. No one will stop. Provided the form is released.
Other people also. Because the input calculation of those things, if it is earlier than the my tax audit period, that is a better.
You have a right to file it, sir. You can file it.
Because my returns depends upon my supplier's returns also.
I get your point, but this is the law. Matching concept. Why? Let's not get into the policy decisions. Yeah? Alright. Now, what are the return related corrections you would be doing in the annual return, which you have not carried out in your the circular 26 examples also? You missed out all the buses. You want to file in an annual return. The general errors which we have noticed in the monthly returns which is filed is, first, the exempted turnover, both inward and outward, is not properly disclosed or not disclosed. Especially you earn interest on fixed deposit, it is never considered for the purpose of reporting. Or I have incurred reverse charge purchases, like we have the 8/2017 exemption, where up to 5,000 rupees I need not pay tax, because the reverse charge was a hue and cry. Why are we not paying tax? Because it is treated as an exempted purchase. Every exempted purchase needs to be reported in my GST 3B. Most of the returns filed ignored the exempted purchases and did not report in 3B. Next, in GSTR 1, table 13 has a requirement of list of documents issued. The list of documents serial number starting and ending is again, though since it doesn't have an obligation to file the return in the absence of it, most of the taxpayers have chosen not to report any information in this. Again, they missed out information of filing the GSTR table 1 table 13, the list of documents issued.
Can it be treated as a suppression of fact for 74?
Yeah, so okay, the question is, the non-disclosure, would it be treated as a suppression of fact for the section 74? Section 74 is a dangerous section, we shouldn't use it that. I would say that it would attract penalty under section 122, and section 75 gives also a reasonable cause asking, okay, why it was not done, even when the taxes are not paid. 74 to be invoked only in an exceptional cases. So it wouldn't fit under section 74, but read section 122, at least the basic general provisions. You shouldn't miss out the penalty provisions. Next, in 3B, whenever the ineligible input tax credit that is not disclosed, the accountant might be less aware. Any bill which has input tax credit, it has been accounted, and whatever the credit is there, it has been reported and filed. So it's an opportunity one can relook at, correct it, and reverse in your annual return. Some of the people have not taken the input tax credit on the IGST paid during imports. It was been clubbed along with the customs duty and treated, okay, it is the total duties and taxes. It was not, input tax credit was not claimed. Couple of errors might be there in your returns, might not be there. I am just giving the general errors which have come for notice during the scrutiny of the returns.
If it has not been translated in the ISK portal, maybe for whatsoever reasons, would it still be ineligible?
Yeah, so I have paid import duty while making the purchase, but it is not captured in the ISGate portal. I have taken the input tax credit, would it become ineligible? The answer is no. You can still go ahead and you have the bill of entry. It would be a clerical error in updating the bill of entry. So you can, when the officer is asking you, you can submit the documents.
Sir, excuse me.
Yeah.
So I have made the export without payment of duty, without filing the letter of credit. In the annual return, can I file it? Can I make the payment and then claim the refund later on?
Okay, so the question is, I have not executed LUT, I have made exports, but I have declared in my GSTR 1 as exports without payment of duty. I have not paid the duty. In my annual return, can I correct it, make it as payment of duty and adjust my input tax credit, etc.?
Or I can claim refund. Suppose this is now.
How will you claim a refund?
Make the payment.
Yeah, make the payment and the claim of refund. Answer is yes. You can make this, any correction, you can do it in your annual returns and do it. Next, reversal of input tax credits. So table 4B is available for reversal of input tax credit, especially when there is a common credit. So you should always wish that, okay, you will be put into 5% tax rate bracket but not exempted supply. Whenever you have this exempted supply, you will always have this challenge identifying the common credit, apportioning based on the turnover, all those challenges, and maintain. In fact, at one point, if the portal was open, submit button was enabled, find the return. That was a great achievement, like an Olympics medal. People were not bothered what data is in. Let me first file the return, avoid this penalty. I can see a good smile. I think most of you have filed today. Alright. Then in table 3.2, there is a requirement of the turnover, though this is not a liability table. The requirement of turnover, disclosure of turnover made to the composition taxable person, etc. Even that is again poorly handled. Next, whenever an amended invoice means technically your invoice issued was correct but you made a wrong data entry. So the amendments of those things are also not carried. So whatever the return once filed, it's filed. It is not reconciled with what was the original data which is there in the books of accounts. GSTR 3B is filed with the nil returns, but GSTR 1 is not filed. Even that is a wrong. Those filings are not happened. Then there were corrections happened where the B2C sale can be made to as a B2B by issuing a credit note, debit note. You can't change an invoice once issued. If an invoice is issued as B2B or a B2C, it is permanently issued as B2B or a B2C. You can't change it. But it is issued as a B2B, but you reported it as a B2C, you can amend it. There is amendment provision always there. Most of the returns have not updated table 12 of GSTR 1, which talks about the summation of all your outward supplies, HS and Ys. In case your turnover is lower than 1.5, you should still disclose, but at least description has to be given. So that information is also not reported or poorly reported. Let's move on to interesting part of the discussion, which is reconciliation. Why at all one needs to reconcile? We have to finalize the books of accounts for the income tax purpose or any other purpose or between ourselves. We are filing GSTR 3B at one point in time, GSTR 1 at a different point in time. Earlier 3B was filed first, 1 was filed later. Now it is vice versa. And while filing those returns, we are very diligent. Whatever the books of accounts at that point of time, we will consider that and we will file it. So what has been filed in one return and other return, whether are they talking to each other, one has to see. Then I am taking credit on one side, is the counterparty also filing the return and are they giving the credits? Is my books credit and 2A credit matched? I have now been getting the love letters from the department. In fact, me and department are friends. They send an email, Gmail using a notice. So as if you are my friend, so notices comes over Gmail. So they send left, right, center. Now I have to reply to those notices. I should have a proper valid data and reconciliation. So for n number of reasons we need to have reconciliations. What type of reconciliations we need to have? One
question.
Yeah.
The GSTR 1, as per the provisions, there is late fee, but that is not getting auto-populated. Nor we can alter the late fee manually.
We pay it along.
So the question is 3B. So ideally the GST when it was launched, they said interest calculation and the late fee calculation will be auto-populated based on table 12 amendment, table 12 reporting of GSTR 2. It used to calculate all those reversal proper handling. It used to do. The GSTR 2 never seen the light. Now then the late fee and interest was made as the data entry. Then after some time system stabilized, the late fee, every time when your 3B is not filed in time, late fee comes. Now GSTR 1 is also not filed in time. Late fee is not calculated. How do I make the payment? I am not able to amend the late fee column. That's the question. The answer is, right now you can pay it by way of challan in the late, but there is no bar in making the payment of the late fee. So it may be used in when the assessment happens.
Do you think the department will start issuing the late fee notices for all the delays in the GSTR 1?
Would department issue a notice for this? Answer is, I don't know. Alright. So let's move on. What do we reconcile? There are broadly three types of reconciliation one has to do. One is with the books of accounts. Next, with the IT returns, income tax returns. Next, with the GST returns. Let's see what do I mean by these three types of reconciliation. Before we get on to the reconciliation, we should understand the concept of section 35 versus Ind AS versus ICDS. Section 35 is talking about payment of taxes on account of your outward supplies. Every invoice in your books of account doesn't constitute a supply. Take a case of a hotel. Hotel recognize revenue on a daily basis as and when a person is staying in the room. Every day they do a posting of the revenue. Doesn't mean that revenue is equivalent to my outward supply. My outward supply is whenever the person is actually checking out and I am raising an invoice. Take the case of construction industry. An apartment construction, the works contractor or a builder raises invoices, first slab, second slab, third slab, fourth slab. But his revenue gets recognized again as per the works contract recognition on revenue. Or I am a trader, regular trader. I have raised an invoice, I discharge the tax for the purpose of GST. But I will recognize revenue only when the goods physically move out of my factory. The risk and reward is passed on to the recipient. Or in the case of a service contract, I am into an AMC service, I have raised an invoice for the 12 months January, I have issued an invoice, I pay the GST in the month of January. But for the purpose of my books, I would apportion it on a 12 months basis. So the revenue which is there in the books doesn't mean it's a revenue of the GST. And it doesn't mean that only a specific industry it has a difference. Every industry it has a difference. In fact, it is not just a timing difference, it's a value difference also. A commission agent would recognize the commission based on a deeming value of the commission based on a percentage of the ticket value. So there is a difference of a transaction value and a taxable value in the GST. But when it comes to the accounts, in accounts we go by accounted value and we follow the matching concept. In GST we follow time of supply, which is earliest of those three. Raising of invoice, provision of service or receipt of advance other than the goods. So we should understand and appreciate that there would always be difference between the books of accounts which is maintained and the liabilities or the outward supplies of the GST. So the section 35 which we talked so far, which we discussed, is not what the books of accounts are maintained under the ERP. It is only talking about give me the details of your outward supply and their liability. I am not asking you a double accounting system. I am not asking you when the receipt happened for that item or how much short received, how much excess received. So there is a difference between the books of accounts under GST and regular books of accounts. So as long as the regular books of accounts can call out the information which is required for the GST, it is sufficient. Like your tax audit, while filing my tax audit, I don't do a separate books of accounts. I make the adjustments in my computation of income, whatever for the purpose of income tax, whatever is allowable, not allowable, increase the value of stock or all those things, I make an adjustment. Similarly, I should be able to show this is my liability for the purpose of GST. As long as if the difference is explainable, there is nothing called abnormal. If my turnover is 1 crore in the books and for the purpose of GST, it is not abnormal for me, as long as the divergence can be explainable. So why do we do the reconciliation? To identify errors, make rectification, avoid payment of interest and the notices, replying to the notices. We have seen the various types of reconciliations. So I will go step by step. First, we should understand from the outward side the terminologies we have: supply, income, revenue, GST, income tax, accounting standards. Like first, IT returns versus GST returns. What differences, probable differences one would have? Under income tax, there is no concept of turnover. In fact, if you refer to the Income Tax Act, there is nothing called turnover. The turnover itself is not defined under the income tax. In fact, you can take a clue that okay, anything receipt can be considered as a turnover. Under GST, turnover is defined 26 and 2112. We have a definition for turnover. The turnover which is there in the GST, when it comes to the income tax, doesn't mean that it will be there in your profits and gains. Your rental income will be in your house property, or capital gain transaction will have the sale of capital asset. So your turnover under GST would also fit into different buckets under income tax return. So you need to have an identification of the differences. How do I report in my income tax? First, my income tax turnover is shown as supply of goods, sale of goods and sale of services. In my P&L of the part A P&L, first they ask by the income tax department is supply of goods and sale of goods and sale of service. It's a mixture of GST and income tax. The word sale is not there in GST. The word goods and services is not there in income tax. So, but it is a mixing both they have asked this information. Now, how would one record this is a challenge. So you need to identify from your books of accounts how do you segregate this difference for the books and income tax separately. In case of a composite supply, person who is doing and supplying an AC and installation, for the purpose of GST, it is a composite supply of goods. So it is a supply of goods, the HSN, and he pays the tax accordingly. But when it is recorded in the books, the management would explicitly want the accountant to show what is the gross margin earned on the AC sale and how much money they are earning on the erection. It is not necessary that the GST I am paying a composite value of 35,000 as my revenue of the supply of goods, but internally I would record the revenue of commission or erection separately and the supply of goods separately. So the records are always maintained for the purpose of again Ind AS or the management requirement. So when it comes to your income tax reporting, you would have to extract what is your sale of goods and sale of services. Immediate next reporting is on taxes collected. Now, as we discussed in the earlier conversation, the reporting in the financial statements is net of taxes. The financial statement would not have the gross value of the turnover and the taxes separately. Hence, you would not be reporting the taxes collected under this section. If you are adding the taxes collected under this section, then your profit gets distorted because your P&L do not have the taxes collected. It has been grouped into your balance sheet. The next reporting, which is there, the challenge you will have also, which you have to consider, is the GST return is 9 months data and IT return what you are reporting in your sale is a 12 months data. So you should have a trial balance drawn up to 30th June and up to 31st March separately for your reconciliation purpose. And some transactions which you will be eliminating for the purpose of GST, which is your transactions for the purpose of income tax, which is the transactions made to your own self. We discussed the difference head where your turnover is reported. Moving on to the next reconciliation, which is books versus the GST. Books, we had a detailed discussion saying that the timing of revenue is different, revenue per se is different. Like the hotel example we took, it is a everyday occupancy is a revenue for the hotel, but for the GST, whenever the customer is checking out, I am making an invoice, is the revenue for the GST. So the timing difference would be there, and the value would also differ because the transaction value versus the accounted value. So the differences between the matching concept and the differences between your section 12 and 13, the time of supply of goods and services, should be calculated by way of a reconciliation statement. Let's look at how would that reconciliation statement would look like. Something like this, not a perfect example. Every business can prepare an example of their own. You would begin with whatever is your credit side of your P&L account, and you will identify some differences which are permanent in nature, some differences which are timing differences. Like actually some incomes which are not reported in GST. So if something which is not even a supply, a schedule 3 activity which is not even a supply, you are not reporting in GST, but there are credits which are appearing in your P&L account, you would eliminate them. You would also eliminate the April to June supplies because it is a 9 months and a 12 months data. Then you will add, there is a turnover only for the purpose of GST, which is your branch transfer. It is not a turnover which is there in the books when I consolidate at a whole level. That branch transfer is not a turnover for the purpose of my books. I will have this profit or loss on sale of asset recognized at a net basis in my P&L. But while reporting my GST, the sale value of the capital asset is recognized. So I will add or deduct the profit or loss, and I will offset with my gross value which is reported in the GST. So these up to this are more like a permanent differences. Then comes your timing difference. I recognize revenue as on 31st March or month month end, because I am following time and material concept or accounting concept, I recognize revenue at the month end. So I reverse that revenue in the subsequent month to match with my GST returns. In fact, this reconciliation statement should be done for each state, for each month. Though I have shown it at a gross level, my personal recommendation, only when you do a reconciliation on a monthly basis, you would be able to explain the differences. Next, reconciliation of taxes is poorly handled. Most of us, we end up doing this reconciliation of the turnover, but we do not end up doing the reconciliation of the taxes. Whenever a tax is collected, it is parked in my output tax ledger. End of the month, if your output tax ledger is showing a balance of 85,680 rupees, if I ask you what does that mean, it is not much an explainable number. So one should have an explanation or a reconciliation of what are the output taxes which are collected. And that is where I said in the beginning, we have to post the month closure entries. What is this month closure entries would mean? We are accepting some liability by way of GSTR 1 and GSTR 3B. So whenever I am accepting a liability in the 1 or a 3B, that is the liability actually which I am recognizing for the purpose of the books. So I would have collected the taxes from the customer, parked in my output liability ledger or output taxes ledger. But when the books are closed, when the returns are filed, whatever the liability which is there in my returns is an accounting entry. One needs to recognize that liability. So you will debit your output CGST, SGST ledgers and credit electronic liability register based on the value which is there in your GSTR 1 or 3B. Now what happens when you record this entry? Ideally, the value in your output CGST, SGST should become 0. Ideally. But after this entry, if it is not 0, if the balance has a credit balance, which means you have short disclosed your liability in the returns. If that has a debit balance, you have excess reported your liability in the GST. So then, if your balance now 85,680, which I am asking in your output GST, you can pinpoint and say that okay, there is some error which happened in month X, and this liability ledger which you have now passed will exactly match with your records maintained by the GSTN portal. This is more like your audit, in external audit confirmation of your tax payable ledgers. Third type of reconciliation is the GST versus GST. We saw books versus GST, income tax versus GST. Now what is this GST versus GST? Like Surya versus Surya Bhumi. Alright. We discussed GSTR 1 is filed at time T, GSTR 3B is filed at time T. Now earlier 3B was filed earlier, 1 was filed later, so there was a timing difference. Now I would have considered some amount of turnover for the purpose of 3B and a different amount for the purpose of 1. Even both these returns, values which is reported in both these returns should also match. So circular 26 also again brought the relevance, that matching of the data. So 3B, table 3, we record all the liabilities. Now when it comes to the GSTR 1, we record from table 4 to table 11, we capture various types of liability. B2B, B2C large, the B2C large and export, B2C small, then amendments, all those are captured in different tables starting from table 4 to table 11. So the summation of these tables 4 to 11 and table 3B, table 3 of 3B should be reconciled. How do we reconcile? First, the 3.1, which is outward taxable supplies, which is a major chunk of the reporting of in the 3B, should have a reconciliation statement of sum total of your table 4, GSTR 1 table 4, which is B2B, B2C large, then export wouldn't come here, deemed export would come, which is 6C, B2C, then amendments of all this. So summation of all these tables should match with 3.18, and you should prepare a simple reconciliation where on a columnar basis, on a monthly basis, you will see whether this is matching or not. When it comes to the exports, which is reported in 3.1b, should match with 6A and 6B of your GSTR 1. Exempted non-taxable nil rated is reported in table 8 and it is reported in 31C and 31E. Again, these values should match. Whenever the values are not matching, you have to find out which is the correct value. It doesn't mean that you have to correct both. You have to first match it with what is the value to be reported, which you have already done with your books of accounts. That is the value which you have to adopt and reconcile or rectify both the returns. Maybe a reconciliation statement of this format, which you have to prepare on a month-on basis from July on a monthly basis. Table GSTR 1 is saying this value, 3B is saying this value, so much is the difference, and this difference maybe in the month of July I have reported wrong, I found it as an error, I corrected in the month of August. So you have, whenever you are seeing the difference, you have to see the difference on a YTD basis. If you are seeing the difference on a monthly basis, it again has a no value, because the monthly correction would have the errors of the previous month brought forward, corrected and adjusted. On a YTD basis, if it still has a correction or a difference, in this example, we see that the GSTR 1 is showing some 19.6 crores turnover, GSTR 3B is showing 19.31 crores turnover. What does this mean? There is a difference of 28 lakhs. It doesn't mean that I have to correct 3B or 1. First I have to find out, is my GSTR 1 value correct? So I have to reconcile, is this 19.6 correct or not? If my 19.6 is correct, then I have to add this additional 28 lakhs to the subsequent month GSTR 3B, discharge my liability and interest thereon. This is how one has to reconcile outward supplies. We have discussed all these issues. Let's move on to inward supply issues. For another 10 minutes. Yeah. Like outward supplies, we have supply, revenue, income. We have now inward supply, expenditure and cost. So again different terminology under different sets of books. So reconcile 3B books 1. Let's move to first as usual, GST returns versus income tax returns. Let's look at where does the reporting happen in the IT returns. In the IT returns, there are 3 places the reporting of GST happens. First, table 7 of part A, right after the purchases, it asks for the duties and taxes paid. One of it is your CGST, GST, IGST. So whenever the books of accounts has any duties captured on account of purchases, only then this needs to be reported. Wherever the purchases tax which is grossed up, which is taken to the balance sheet as an input tax credit, wouldn't come as a reporting item under this table. Next, rates and taxes, which is 36 table of the part A of the P&L, where whatever the owing to your reversal, rule 42 or ineligible credit which you are reversing, and if you are reversing to the rates and taxes, that rates and taxes would be reported here. But where your reversal is on a gross basis, you are adding to the natural head of account, you need not split it and add it here separately. Next, interesting reporting which has come into clause 44 of the tax audit report, thankfully which has deferred for some time, but it is there for the ITR 6 where the non-tax audit cases, that is not deferred, where your expenditure has to be split. The total expenditure which is reported in the GST has to be split between GST and non-GST, and when it comes to the GST, how much is it from the composition dealers, how much of the GST which is not liable for the tax, how much of the expenditure of the exempted supply, and how much of it for the taxable supply. So your expenditure needs to be split into these columns. It appears to be a huge challenge in preparing this data. But trust me, if the books of accounts are maintained properly, if the configuration of the ERP is proper, extracting of this information may not take more than 10 minutes. Because every time when you recognize an input tax credit, you pass an entry debiting your debit expenses, debit input tax and credit vendor. If you crawl through all the voucher entries which are there in your input tax and do a cross reference of your vendor and the nature of expenditure, with a simple pivot table, you will get how much of the expenditure is GST, and subtract that with the trial balance total will give you a non-GST expenditure. And you have a by vendor, if the GST is captured, you would know the exempted purchases and the composition purchases. The balance data would automatically go to column 7 of this reporting table, which is total other expenditure. So the configuration of books of accounts is a very key item. The deviation with the expenditure is also in the similar line with the income deviation. We have seen the examples of the income. The same examples are applicable for expenditure. Instead of AMC income, which I realized in the month of January, I apportioned it for 9 months. Now I would have paid an expenditure to someone for a 12 months contract. I would have apportioned it on a period basis in the P&L. And for the purpose of GST, the inward supply material has received, or the invoice has been received, the input tax credit has been availed. So there would be a timing differences. Same like your expenditure, you will have income, you will have a timing difference. The matching concept would kick in even for the expenses reconciliation. I will not get into the details of it because these are the same examples of your income differences. Certain other items, which is expenditure deviation, you would have provisions and contingencies. You will neither report it in your 3B, nor it is an outward supply to a third party, nor it is an inward supply, or bad debts which is written off. So if you see the GST reporting of the expenditure, even it also has eliminated table 7 and table 38 onwards, provisions, write-off, the depreciation, amortization. Even those expenditures are taken out for the purpose of income tax return, because they exist only for the books of accounts, and it is not there in your GST returns also. So that data would be kept out separately. Like your income reconciliation statement, you would have an expenditure reconciliation statement, because this reconciliation statement is required for your income tax reporting also. Of the total expenditure in your P&L, how much of the expenditure has suffered GST, how much of the expenditure has not suffered GST. You should be able to segregate, and with a simple configurations in the ERP, this is an extractable data. But if you maintain this on a monthly basis, it gives an interesting facts. Couple of interesting facts that would come is you would realize that a huge amount of the importation of services happened where RCM is not paid, because the expenditure will move to a non-GST suffered column. You have an opportunity to explore, is there any RCM transactions in it, or there was a past practices of not availing input tax credit on the capital expenditure and not knowing the provision. Someone would continue to use that, okay, these items are not the one which I am selling. They wouldn't have availed the input tax credit on certain expenditure. So when you prepare a reconciliation of the total expenditure, how much of the GST suffered and non-GST suffered, you will also have an opportunity to rectify mistakes if there is any. Like reconciliation of the turnover and the expenditure, you should also reconcile your credits and liability. So every month after you file your GSTR 3B, you should record a month closing entry, which is your debit your electronic credit ledgers, electronic credit CGST, SGST, AGST ledger. You will debit that ledger and credit your input CGST, SGST and IGST. When you post this entry, and the base value of this entries would be your GSTR 3B. So when you post this entry, ideally the balance in your input CGST, SGST should have become 0. Even after this entry, if there are balances in that ledger, assuming if there is a debit balance continued in your input CGST, it means that you have not recorded some credit in your returns, your 3B returns. Some credit is still left out. Or if that balances as a credit, which means you have excess taken a credit in your electronic ledgers. And these electronic ledgers are a mirror replica of what is maintained by the government portal. It satisfies an external evidence for the statutory auditor and external confirmation. By this way, one will also ensure reconciliations and control on proper recording of the data. So couple of issues, as I said, credits what are fixed assets are generally not availed in some cases, so one has to check. Expenses covered in RCM, the month-end entry, both the liability and the credit to be recorded. Missed out credits on some expenditures like a bank charges or anything, it would be an opportunity to check. Or you would also, during the reconciliation, you will find out that the credits are generally there in one side of the table 4A of the GST or 3B. The reversal of those credits, especially the blocked credits, or you have to apportion based on rule 42, 43, those missed outs apportionment will be brought out during your reconciliation statements. As I said, this presentation is available. I will only touch upon the important topics. Now, lastly, returns versus returns. In 1, it is clearly known that I file my 1 and 3B. There is a returns versus returns. But in GST or 3B, I only file GST or 3B. Where is the question of reconciliation of returns versus returns? Though you are filing only 3B, there is a counterparty who is filing their GST or 1 which is available as a 2A for you. You should still go ahead and reconcile. Let's look at what is that I record as an input tax credit. First, I take the input tax credit on import of goods, import of services, then reverse charge credits, ISD credits, all other ITC. How do I reconcile these credits? All my import of credits should be reconciled with IceGate portal. So in my IceGate portal, with my bill of entry and with my IEC code, I can actually log in and see how much of the duty which is paid and reported. In fact, when this exercise was done, that is where I said that the customs duty is included with IGST and recorded. The credit was not availed. You will also have an opportunity to avail missed out credit. Not that every time when you do a reconciliation you will have a reversals. You will also have a credit, missed out credits, which you will be taking. The second 4A2 and 4A3 which is a reverse charge credit which you are taking. Any reverse charge credit which you are taking, you are offering it as a liability in your table 3. So whatever you are paying as a liability in one table should automatically carry forward as a credit in another table. So when you do this, you will also realize, interestingly, you have paid taxes but missed out taking credit under this table. Next, in case of an ISD credits, so the part B of GSTR 2A now gives the details of all ISD credits. So your line items of part 2A should match with your ISD credits. And very important item, which is your all other credits. This is a favorite entry for all those people who record the credits. All the credits are recorded under 4A5. So every credit in your 2A should be either an eligible credit or an ineligible credit. Whether or not it is eligible, it is appearing in your 2A. Just because it is in 2A, it doesn't become an eligible credit. This eligible credit should match with your 4A5 and 4D, subject to those amendments, debit note, credit notes, all those adjustments. So one has to, similarly the way we did a reconciliation of GSTR 1 on a monthly basis and 3B, similarly on a monthly basis, the 3B versus 2A one has to carry out the reconciliation. And you will find the differences. Recording of differences, we discussed whether debit note, park it to a separate entry, P&L debit, all those, however you would want to do, you would have to do it. Moving on to the annual return. The annual return, we saw the tables would have the supply, outward supply and the sales return, purchases and purchase returns, the taxes paid and taxes adjusted. So these credits adjusted is reported in the annual return should also be reconciled. Yeah, we have seen the reporting under CARO. Some other non-compliances. We saw the registration non-compliances, books of accounts non-compliances, invoice related non-compliances, return filing non-compliances, reconciliation non-compliances. With regards to the configuration of the ERP, I did not want to bring out all the non-compliances, but as I said, the ERP, it could be a generalized ERP or a customized ERP. A generalized ERP would come with all standard modules of the GST. one has to go through the standard modules and it has to be configured. Once the ERP is configured, the relevant tables are automatically extracted or extractable. If that is not happening, the ERP is not configured properly. The differences between the numbers is normal. It is obvious. If you do not have the differences is when you should really worry. If you have differences, you should not worry. And nothing is abnormal. I said the difference between 1 crore, 2 crore, 50% deviation, that is also not abnormal if you have a reconciliation. Only when the divergence is unexplainable, only then it would be an issue. So the mantra of your finalization of your accounts or record keeping is reconciliation. If you have reconciliation, like in life we reconcile with each other. So if you reconcile the data, then you'll be sailing through with your books of accounts complaints. With this, I end my presentation. Thank you. So this presentation will be available. You could be downloading from Monday.
So on behalf of panel bench, heartfelt thanks for your excellent presentation, sir. Big round of applause, ladies and gentlemen. As a token of appreciation, I'd like to present in small little portion. I request Madhukar sir to kindly come forward to present. Gift voucher to our speaker, Venugopal ji. Big round of applause.